I thought this week I would just cover something that's come up quite a lot and constantly comes up actually in terms of loaning cash between connected companies. So here I'm talking about where you've maybe got a trading business, you've built cash up in that business, and maybe you want to invest that cash. If you were to take that out as a dividend, you would pay up to almost 40% in tax, and then you'd have the money to reinvest. So what often people will do is to use a separate company, so still connected, same shareholders, however, they will just lend the money to that company. It's not come out personally, therefore no dividend tax, and that should be the end of it. Unfortunately, there's a little bit more to it. We have something called Section 455 tax, which relates to loans to participators, but of course here, we are not lending to the shareholders or participators, we're lending to a company that's connected with them. So Section 455 itself doesn't apply. We do have similar legislation, which is Section 464A, which in theory could apply, but there is an anti-avoidance rule applying to that. So if you lend money to a connected company, perhaps, as I say, a lot of people do it for property investment, unless you're doing this for tax avoidance purposes, Section 464A shouldn't apply. So normally I'm fairly comfortable, provided you've got a commercial loan, the loan is always intended to be repaid at some point when the property company has the funds to do so, you shouldn't fall within Section 464A, and therefore there should be no tax charges on a commercial loan between two connected companies. The other issue you have though, is if you decide to write that loan off. That is arguably an indirect distribution to the shareholders. So what HMRC will say, even though you've got a loan between two companies, what you've actually should have done, taken the cash out of your trading company, that would be a dividend, loan it back into the property company, and you'd be owed the money back from the property company. So indirectly, you've received a distribution by writing that loan off and it no longer being in existence. Now, that's not always the case, but if both of those companies are solvent and the decision is taken to write those loans off, then there's a very good chance that you could fall within the distributions rules and that value of that loan is going to be subject to dividend tax. The one exception, or the main exception here, is if the company is insolvent. If they can't repay the loan, then the value of the distribution is the value of the loan when it's written off. So if a company is insolvent, can't repay the loan, it's written off, it's not worth anything anyway, therefore the distribution is zero anyway.
As always, like, comment, share. It lets me know that these videos are well received, and if you have any comments or interpretation of this legislation, really interested to hear everyone's thoughts.